Hello, everybody. This is Mr. Lu. I haven't done an update of my Endowus portfolio for a long time. I thought it's about time that I share with everybody. A major milestone has been hit. So I thought that there are a lot of experience and lessons that I can share with everyone. So please watch on, and I hope that this will be useful for you to hit major milestones in your own journey as well. To start off, I just want to put a caveat. This is not a bragging session. This is not a Howlian session. This is a session where I share with everybody my know-how. I think it's important for everybody to know that my Endowus portfolio is mainly CPF, maybe a bit of SRS. So all this has limitation. It's not that the richer you are, the bigger your portfolio is and things like that. Rather, this is about investment experience and what you put your money to work. CPF is a very powerful equalizer, right? A lot of us have the same amount of CPF. What you do with it, will determine how far you can stretch. So I'll share my journey with you, what I've done, some lessons you can pick it up as well. Let's go on, shall we? So this one, I want to give a major disclaimer. As usual, there's a lot of things I want to share is all for education, entertainment. But more importantly, a major disclaimer that I want to share is that I am a small-time Endowus investor. So I'm a shareholder of Endowus in a small way, very small. Relative to the size of the company, I hold very, very little. The founders were very kind to invite me to invest. Anyway, so before we start on my Endowus portfolio, it's important to note that yesterday night, the stock market reached another all-time high. So yes, it has broke through another high again. And it looks like this all-time high will be happening again and again and again. There'll be some retracement, there'll be volatility, but it keep going up and up and up. And I think that's a wonderful experience to ride on a bull run. And the main reason why the market went on a bull run again yesterday was because the unemployment rate in US creeped up to 4.1%. That was a small increase relative to the consensus view. And that's a good sign because it shows that the labor market is now coming to equilibrium. Demand and supply is at a level where the policymakers want it to be, and when the central bankers want it to be as well. So I think this is good news. It shows that service level inflation could be creeping down. So I think all these are good signs. The market took it very positively, and then they rallied up again. And it's very clear now to everybody that there is a rate cut that is coming. I think everybody is now talking about a current interest rate cut of 5.25% to 5.5% is no longer sustainable. And I think the Federal Reserve is likely to commence on rate cut, likely somewhere in September or slightly later. So I think these are all good news. The stock market, and the bond market will have a very positive reaction. I would like to share my Endowus portfolio. I actually coined this phrase 1M51EA. It's quite a mouthful. Ben thinks that it's a terrible long abbreviation. So I also agree. But it simply means 1 million by 51 years old, which I am now, in Endowus alone. Okay, quite a mouthful. So some people say just 1M51E will do. But anyway, these are my personal reflection. Yeah. So this is my screenshot I've taken from my Endowus account. So it just crossed 1 million. I've not factored in last night the further upward adjustment. I think it will end around 1005 or something like that. There is an increase of about 54% from what I've invested. I started my journey with Endowus around 2020 April. That was when there was a massive crash and I fired my first shot. That time, I think that few shots that I fired all the way to June, probably is about 300K or so. I fired a few more shots in 2022, the great inflation. Part of it are my CPF OA portfolio, and there's a bit of SRS involved as well. I initially invested all in Line Global. Then on the advice of Sam Ree, the Chief Investment Officer, I took out half of it into a Mandi. And interestingly, a Mandi portfolio now increased more than Line Global because I think the Mandi is not exactly a replica of S&P 500. It is a very close clone, but I think they put a bit more weightage on the tech. So that's why Mandi went up, but it's not very far away. The question is, how did I do it, right? I think the first question is, Mr. Lu, is it timing the market or time in the market? So yeah, my answer is this. Well, I did both, right? I did both. Mr. Lu do a lot of timing in the market is in the sense that I crash buy. I only do crash buying, okay? Only. So during market crashes, I buy a lot. And then I hold them for a very long time and let compounding take its course. I don't profit take. I do some rebalancing occasionally to balance off with the bonds. but I generally only buy. So there's a part of it that is timing the market. I crash buy, but I don't time the market in the sense that I buy, sell, buy, sell, buy, sell, buy, sell, buy, sell, that kind of thing. Yeah, I don't do that. I'm not capable of doing that. A lot of you think that you're capable of doing that. Go ahead, but I'm not capable of doing that. Once I crash buy, and then when the market recover, the uplift, and then it gradually grow in its usual path of compounding. So in that sense, I also do time in the market. So I let it compound over a long period of time. So I think the real thing that I want to share with everybody is that you don't need to choose between timing the market and time the market. You can have both, like what I did. And there is a part where everybody is asking, when do I sell? I did a video yesterday about when I think I will sell. So you can watch the video yesterday. But I actually think that I will hold the portfolio for a very, very long period of time with some adjustment to rebalancing, and I'll avoid a major financial crisis event. But those kind of events are very rare. So, Mr. Lu, what about dollar cost averaging? Everybody is talking about dollar cost averaging. Well, the frank truth is that I don't do dollar cost averaging. I recognize that dollar cost averaging works in the long run for many people, and in theory, it should work. I want to share a bit of this experience. I say it many times, and I say again. If you are starting dollar cost averaging now, you should go check yourself whether you really can handle it. Why are you only chasing bulls right now, right? It's a market high. Why didn't you start dollar cost averaging where it's somewhere in the middle or somewhere in market lows? Why only do dollar cost averaging in this kind of market highs right now? So in short, you are doing more FOMO than dollar cost averaging. And chances are, if you start dollar cost averaging now, when the market goes down, you will stop your dollar cost averaging, even if you automate the process, because you can always stop it, right? So from my experience, successful dollar cost averaging requires you to ride through all highs and lows. And if you're only doing on the high, simply means that you're FOMO and chasing the market. I think it's very, very dangerous. Okay, it's very, very dangerous to do that. So I don't think dollar cost averaging will work for people who want to start dollar cost averaging now and didn't start way earlier. I think there is a lot of theory that says that if you buy on market highs, it's actually not a bad time. That is true. If you look historically, if you buy on market highs, it will lead to more market highs. It's just that I don't believe in chasing market bulls. I just want to say that if I chase market bulls right now, it simply means that I run the higher risk of when market crash, I'll go down below water. If I chase market bulls, there's a good chance that if the market crash, I'll lose money. So I like to buy on market crashes and wait for the next market crash to come. Buying on market high simply means that the risk get higher and higher. I think I'm a risk-averse person. I can sleep better without having this risk. So I don't subscribe to this practice. I recognize on paper this can work and it should work, but I don't like it because I can't sleep well with in taking on this very high market risk. So in short, I don't believe in chasing market bull runs. As you can see, buying on market crashes works fantastically for me. It's compounding very powerfully right now, and it's wonderful. A lot of people ask me, Mr. Lu, how do you do market crash buying? Well, I've done it 6 times already. I'm getting better and better at it. I'm not trying to brag because there is science to it. And you know what? I actually share how I did it, right? There is no holding back of how I did it. And it's just plain macroeconomics, applied economics in a very pragmatic way. So I've done it during the great financial crisis. I bought during the market crash. And then the 2012 Europe debt crisis, I bought it again. 2015 China stock market crash, I bought it again. The trade war of 2018, I bought it again. During COVID 2020, I did again. And I, of course, did it this time very openly, very transparently to everybody during the 2022 great inflation. So I've gotten better and better at doing it. Experience do help as well. And I am very open in sharing with everybody how I actually did it. I'll just give you some examples. I'll give you 2 examples of how I did it. In 2020, during the COVID crash, it was a terrible time and the stock market just crashed phenomenally fast and things like that. But it was then that the Federal Reserve announced QE Unlimited. That's quickly ring a bell. And I look back to 2008 and 2009 when the Federal Reserve did QE 1, 2, 3. So that was where I first recognized the power of quantitative easing. In quantitative easing, the asset inflation is phenomenal. All the assets in the stock market will inflate phenomenally when there's massive printing of money. It was very clear that during 2020 QE Unlimited, the result will be a massive asset inflation. So when I saw that that was done, I quickly slammed in a big amount of investments and fire a few big shots. So it's proven correctly. So the signal then was about QE Unlimited, and the precedent then was 2008 QE 1 and 2 and 3. In 2022, great inflation, and there was a huge spike in interest rate. This experience was a close mirror of what happened in the Volcker's Bear. And this part, I've said at least 10 to 15 times what I was doing, and I relate back to Volcker's Bear again and again and again. And I told everybody in every shot I fired that the same history will repeat again. And guess what? You look at the two graphs. This is 1980s, and this is the current market right now. Can you see an incredible resemblance? And somewhere around here, I already started telling everybody it will be a mirror image of what's happening. And guess what? It really did, right? It really did, right? It's just a plain copy. Getting pretty good at it, not because I'm good, because I just look back at history, find a similar event, look at the macroeconomic signal and apply it. This is really applied economics at stock market. It's very easy for people to pick up the same skills by just looking at what has happened. If I were to talk about what happened in previous stock market crashes, it would be too long. I'm happy to do another video. I hope that you recognize that there is no secret sauce, and this is actually a very simple application of historical events into current event by reading the same macroeconomic signals. So what is Mr. Lu doing right now? Should we buy? Well, I just want to say this, that in good times, I like to gather dry powder. In bad times, I crash and buy. Now is good time, I gather dry powder. I make my income, I earn money, I run businesses, I make profits. I accumulate dry powder right now and wait for a major crash to come. I can assure you a major crash will come. I just don't know when, right? So when it comes, I'm ready because I'm holding on to a hammer that gets bigger and bigger and bigger, and it gets heavier and heavier. And so whenever the crash comes, I just slam onto it because I just waiting for a long time. I don't think we need to kanchong and chase market bulls. That's for me. Some of you want to, go ahead. There's nothing wrong with doing that. I just don't like to do this. I think this is where good times like now, I gather dry powder. I think there's a biblical story about 7 good years and 7 bad years in Egyptian time, where the Pharaoh, on the advice of Joseph, accumulate a lot of grains, a lot of food and all this, and then there was a 7 bad years where they then release it and sell it and make a lot of money. I'm not so sure whether it's 7 years or 3 years or 5 years. I don't know, but I know the philosophy of gathering dry powder in good times, and in bad times I just crash and buy. Worked 6 times for me already, and the last time I shared everybody. So I hope this philosophy is something you all can think about. I think there's some questions about, is S&P 500 the way to go? I think there are some people who say that S&P 500, has a lost decades. S&P 500 is overly US concentrated, blah, blah, blah. I don't deny those things, and I think that is true. I just want to say this, I don't have my whole heirloom, I don't have my whole life and blood into S&P 500. I can't exactly remember what's a share, maybe 15%-ish, or maybe even less into S&P 500. That's my entire family wealth ratio into S&P 500. But I think what I want to share is this. The S&P 500 has stood the test for 100 years. It's gone through 2 world wars, Vietnam War, Korean War, I don't know what other wars are there. You went through several oil crises, went through several inflation, went through a great depression, gone through a great recession and things like that. I think it can stand a lot of fire. Okay? I think there could be major retracement, but that's historically the same as what has happened before. Many of the global funds, MSCI World Index, Dimension Fund and all this, they're also about 70-80% concentrated in US. So it's not easy to avoid US anyway. If you want to diversify, I would suggest do US treasuries or other global treasuries, bonds, Singapore T-bills, I think is good as well. Singapore SSB and property, CPF, whatever, right? If you want to diversify out of stock market entirely, then you have a diversified portfolio. And I do some of this as well. So just a food for thought for everybody. I need to say this again and again and again. This is my personal formula for myself. I'm not saying that this is the right strategy for you. All of us are made up differently, emotionally and financially, wired in a different way. So you have to adopt and adapt a strategy for yourself that is suitable for you and your funds. For me, I think this is quite suitable for me. I share with everybody. Pick the bits that are suitable for you, junk the rest. If it's totally not suitable, throw it away. Some of you do very well in property, good for you. Some of you do very well in dividend stocks, good for you. Some of you all can identify and stock pick, good for you. Some of you are good in crypto, good for you as well. For me, I just pick the one I'm suitable for myself. So for many of you who are now doing very well in the stock market, congratulations. Be aware that retracement will come, market downs will come and things like that. Just prepare to sit through all this volatility. I'm holding on to my portfolio. I don't know about you guys, but I'm very happy about my performance in my Endowus portfolio. For those people who are interested in Endowus, go look up their email and help desk and app and things like that. I think they'll be more happy to help you. Thank you, everybody, and I'll see you in a day or two. Bye-bye.